People often forget how powerful credit unions are until the economy squeezes them. When inflation rises, when access to credit tightens, when banks become more conservative, suddenly members begin to remember the value of cooperative finance. But here's the deeper question. Are credit unions simply alternative lenders? Or are they something far more essential to economic stability? This is the Cooperative Voice, the space where we break down the issues, opportunities, and hard truths shaping the cooperative and credit union movement across the region. Let's get right into this insight. Across the Caribbean and globally, we are operating in a period of economic pressure, rising costs of living, interest rate volatility, supply chain disruption, and regulatory tightening. In moments like these, financial institutions become stress tested. But history shows something interesting. During financial crises, including 2008 global financial collapse, credit unions consistently demonstrated stronger member loyalty, lower volatility, and deeper community engagement than many traditional banks. And the question you will ask is why? Because credit unions are not constructed or structured like banks, and structure determines behavior. And let me break this down for you. First pillar, the reality. Member ownership versus shareholder profit. The first and most important distinction is ownership. Banks are shareholder-driven institutions. Their obligation is to maximize return on equity. The credit unions, on the other hand, are member-owned cooperatives. Their obligation is to maximize member benefit. And herein lies the difference. The single structural difference changes everything. In a shareholder model, profitability drives decisions. In a cooperative model, sustainability and member value drive decision. That means loans pricing reflects member affordability, dividend return values to members or return value to members, and fees are structured around service, not extraction. This is not sentiment. It is a governance architecture. And the question you're going to ask is, why am I saying this? Because there's an inherent risk if we misunderstand this, especially as it relates to community reinvestment and grassroots trust. If credit unions begin to imitate banks without preserving cooperative discipline, they risk losing their competitive advantage. Credit union reinvest locally. Profits are not extracted to distant investors. They circulate within communities. They finance education. They support small businesses. They stabilize households. That creates grassroots trust. And trust is not built through advertising. It is built through presence. So when institutions drift away from this model, they weaken their social capital. And in crisis, social capital becomes more valuable than financial capital. And what does this translate to? Flexible lending and crisis performance. Another structural strength in the case of the credit union philosophy is the flexibility. Credit unions understand member income patterns, seasonal workers, small entrepreneurs, public officers, farmers. They do not lend solely through rigid scoring algorithms. They lend through relationship building underwriting that allows, one, restructuring during hardship. So when a member comes into the credit union and has a difficulty repaying, that credit union loan officer will sit with that member and attempt to restructure their loan. Two, payment holidays in disaster. Tailored solutions for local realities. So there's a popular adage which speaks about forbearance, which is what we call payment holidays. So a lot of credit unions during the course of Maria and during the course of COVID would have given moratoriums or would have given a little payment holiday for the members. So members do not pay towards this period, or they get a 6 months moratorium on payments or payments to interest or capital. This is what we refer to when we say payment holiday. And that is precisely why, because historically, credit unions have outperformed other financial institutions during crisis. And this is not because, as people would think, because they take excessive risk, but because they understand their members better. That understanding reduces what we call the moral hazard. It improves repayment culture and it strengthens member loyalty. So you'll be asking, so what does this mean in practice? Well, here's the practical solution or the practical application. For the board of directors, the board would need to reaffirm cooperative identity in strategic plans. Ensure that this is enshrined in your strategic plans. 2, measure member impact, not just in asset growth. And a lot of times, in our financial statements, in our annual reports, the focus on the trust is in asset growth, savings growth. And we're not looking at the quality of the impact on membership, or to measure the impact on the membership. So not just using metrics such as growth in assets, but also how has the credit union impacted the lives of its members. For the management, design products around affordability, real-life affordability. 2, strengthen relationships, lending frameworks. And 3, protect liquidity while maintaining flexibility. Now, from the staff perspective, you have to remember who you are serving. You are not serving customers, you're serving owners. Every interaction either reinforces or weakens the cooperative trust. So here's the strategic takeaway. Credit unions are not just simply financial intermediaries. They are social stabilizers. They absorb economic shocks, they maintain access to credit, they preserve dignity during hardship, and they circulate capital locally. And in volatile environments, stabilizers become indispensable. Now, the real power of credit union is not in their size, it is in their structure. In our next episode, we will analyze something that threatens all credit unions, regardless of its size: the real cause of delinquency. Because delinquency is not just about unemployment, it is often about systems. And if we misdiagnose the cause, we apply the wrong cure. If this added value to your understanding of the cooperative sector, share it with your board, staff, and your members. And until next time, let's build stronger cooperatives together.